Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. We had a very powerful inflation number out in the United States yesterday, and everyone knows about it. The markets reacted to it. We've seen the US dollar fall back sharply. We've seen stocks rally sharply. What I think this inflation number says to us is that probably, yes, we could now start to feel a little bit more comfortable that the absolute peak in inflation, US inflation, has been seen. But it's not entirely a situation that's out of the woods yet. We're still at extreme levels. Inflation was running at almost non-existent levels, and now it's still at 7.7%. All of the time that inflation is above 3-4%, it's damaging the economy long term. That kind of fracturing of the fundamental basis of the US economy is continuing. However, you do have to say it is a good number on the day, and the market has certainly reflected that. My takeaway from all of this would be that we have probably seen the inflation peak, but we are still a long way from seeing inflation back towards 5.5%, which could trigger the Fed to really think about pausing. I think anywhere between 7.7 and 5.5% inflation on the way down is still the Fed hiking by 50 points or 25 points. So the Fed is going to continue to hike. I recently put out a report saying I believe the US Fed funds rate will peak at about 7.5%. If inflation were to continue to fall away as it has in the last month, then obviously I'll bring that down to 6.5%. I'm still going to be above market though, because I think the market still underestimates how serious a problem inflation is and how deep believing of that point that it is an incredibly seismic shock that will hurt the US economy for perhaps a decade going forward, and therefore it has to be stopped as quickly as possible, is why the Fed will continue to raise rates. So this number, the Federal Reserve will react to by saying, these are encouraging signs. We can slow to 50-point rate hikes, or we can slow to 25-point rate hikes, but they're not going to stop hiking interest rates. So interest rates are still going higher in the United States, which means the yield differential to currencies like the Australian dollar are probably headed higher. It is possible that the US dollar, and I have warned of this before, that the US dollar was becoming a bubble and at some point it would begin to burst. It is possible that it has begun to burst without me being totally on the ball and seeing that happen in real time, but at least we've been giving you the concept. Now, if the US dollar is going to continue to weaken, and remember, it's down against the yen, it's down against absolutely everything on the day, it's even down against the Russian ruble. In fact, compared to where the US dollar ruble rate was before the war, before Russia invaded Ukraine, the ruble is about 20% stronger against the US dollar. So the US dollar during this period overall has been weakening against the Russian ruble. So there are signs that the US dollar overall, it's a bubble that will burst. I have no doubt about that. I just didn't think it was going to burst this early. I think be very careful about the volatility on the day and over the next 1 to 2 days, because it's possible we'll see another spike higher in various currencies against the US dollar over the next 24 hours, but then a bit of a tiredness, bit of a profit taking, the market falling back again, maybe some long-term buyers of the US dollar coming back in there. With stocks, similar story. Fabulous reason to buy on the day. Keep buying, momentum trades kick in. It could go higher for another 1 to 2 days. But again, this falling inflation does nothing to prevent the decline in services and manufacturing that we are seeing across the United States. So the United States, I said from the very onset of inflation, it has far more problems than inflation, and inflation won't help. That inflation is still where it is still incredibly damaging to the US economy, and the US economy has other challenges, and it now has policy paralysis in Washington. So the outlook for the US economy is unchanged by that improvement in the inflation number. And please do not get too carried away in the fact that the inflation number improved, because it's just gone from super high extreme inflation to super high extreme inflation that's a little bit lower. So do bear that in mind, because that is how the Federal Reserve will view it. So keep that in mind in how you're assessing what's going to happen from here. Any thoughts or ideas that the Fed will now stop hiking rates or pivot? Absolute fiction and nonsense, as I said it was all the way along, and we've been right. So yeah, don't get too carried away with that. I'm concerned that the short-term trading market could get carried away with that idea, that false belief. And that's why we could see stocks overshoot a little bit here to the upside, and the US dollar overshoot to the downside. But do stay aware that the US dollar is a bubble, but it is going to still have a very high yield relative to other currencies. It's a bit of a trade-off. And that the US economy and why stocks are down is, I've always said, stocks aren't down because of the Fed raising rates. Stocks have been falling since the first week of the year, well ahead of the Federal Reserve raising rates. So stocks are falling for underlying fundamental economic problems in the United States, and for an earnings outlook that's very mixed, if not negative, really. And we've seen Facebook fall 70% this year. From its highs. There's all the writing is on the wall in a variety of places, but that was a great one-day rally for the US stock market. It could have another bit of follow-through. I am not a believer in this rally. However, coming across to the currency side, please note the euro has broken out of its major downtrend, and it is breaking up on that. So there's a lot of technical buying on that, as well as this fundamental development of perhaps the Fed will begin to ease its rate hikes. If anyone's saying the Fed's going to stop and the ECB is going to catch up to Fed interest rate levels, that's just not going to happen. So just be careful about that trade. Mixed feelings on that one. Thanks very much. All the best. Clifford Bennett, Chief Economist, ACY Securities.